Good morning. It's January 24th, 2026. This is Robert Sin at CEO Technician on X, at Goldfinger on co.ca. And this is my presentation for the Metals Investor Forum in Vancouver, Canada. The title is Metals Wars: The Old World Meets the AI Deglobalization Age. And, sometimes it's not easy to do these presentations in exactly 20 minutes in front of a packed room. I had to skip some slides during my presentation, my live presentation. So this one, I'm going to go through all of them, and we'll probably do it in about 30 minutes. Forward-looking statements. I will make some forward-looking statements, and I will talk about some individual companies. It's not investment advice. Please do your own due diligence and consult a financial advisor. So we start with the turning of the new year. At the end of December 2025, it felt like tension was brewing, momentum was building, things we'd never seen happen before were happening. Silver, I think, was ground zero for it, obviously gold as well, but silver really in that push above $80 an ounce, that first thrust above $80 an ounce when social media was ablaze and talk about silver, right? China has very strong control of the silver market, as it does many metals. So many metals, I can't even come close to naming them all. Like 100 metals. China controls the processing, has very strong mining globally, a strong set of mining assets globally and including inside of China. And they get the metals trade. They have metals traders, right? Stuff the West doesn't have in as much abundance. So I believe that we were seeing something there at the end of 2025, which is now carrying over, spilling over into 2026. And it's reaching mass consciousness, right? I think like we hit the 2% threshold in terms of metals and critical minerals. We hit the 2% threshold, right? Maybe at the end of 2025, where 2% of humanity became really aware of what we're dealing with. And now it's starting to go parabolic. So maybe we're at like 4 or 5% now, or 10%. The awareness is growing. And in a case, a great example of that is this Substack post that I wrote on January 7th, summarizing and taking out, extracting some key highlights of Robert Friedland's presentation at the University of Southern California in 2025. This YouTube video had been up for like 2 months. When I got to it in early January, it had like 800 views. I haven't even looked what it's at now. I think it's over 10,000. But this Substack post has over 130,000 reads now, right? Over 130,000. So I've been blogging for over a decade. Usually my best content, my most viral content would get like 10,000 reads, which is good. I'm grateful. I'm grateful for all of it. I'm grateful for 1,000. I'm grateful for one. But 130,000, right? Like 10x what my previous best was, right? So I kind of think of it as like my content, my Substack was kind of like the silver chart in a strong uptrend, a steady uptrend for a couple of years, and then just parabolic breakout in January. And it's a trend, and it's still early because of what needs to be done. This is what a lot of people are having trouble grasping, is that it could still be relatively early. I'm not saying first inning anymore. I think we've transitioned. We might be third inning now, but it's still pretty early because the US government has concluded that critical metals, so metals, high purity metals, pose a national security threat, right? And this is something that was never acknowledged before, right? All these presidents, Reagan, Bush, Clinton, Obama, like they never acknowledged that our raw material supply chain runs through China, right? It started in the 80s, it accelerated in the 90s, and it really accelerated in the 2000s, right? And by 2025, China has us over a barrel, right? China has us over the barrel. And so if we want to produce Patriot missiles to send to Ukraine or Israel, or we want to make those cool B-2 bombers that can go across the world and drop 30,000-pound bombs, well, we're dependent upon China for it, right? The U.S. is dependent upon China. So, yeah, the U.S. has the strongest military in the world. I think everybody acknowledges that. But if the U.S. engaged in a serious conflict with a reasonable adversary, I'm not calling for World War III, but if it actually happened, if World War III happened, the U.S. wouldn't be able to, keep up for more than a couple months. Eventually, it would run out of missiles. It would run out of tank ammunition. It would run out of all sorts of things without China continuing to supply us with these critical metals. And so the theme now in 2026 is metals independence and full energy independence, right? And when I say energy, I just don't mean nuclear energy or natural gas or oil. I mean copper, right? I mean battery metals, lithium, nickel, right? And I'm not going to go through the whole periodic table with you, but you can look it up. There's a lot of metals that feed into this. And so David Copley is the Trump 2.0 mining czar, former Newmont guy, very sharp guy who really gets it. And he delivered this speech in Riyadh, Saudi Arabia at a big conference. And I'm going to let you watch this on your own. You can find it on my Substack. It's posted there. But it was very impressive. And he basically laid out 4 key points. And the U.S. is not messing around anymore. They're supporting the mining industry. They're putting in price floors for metals. That's something completely new. And that's one of the reasons why the mining industry in the US has languished, because China was always able to compete at a lower cost structure. And they were always able to dump into a strong market and knock prices down and force US miners, the supply of metals in North America out of the market. So nobody wants to spend $2 or $3 billion to build a big new copper mine when China could knock the price back under $4 if it wanted to, and make the new North American mine lose money. So price floors changed the game. Secretary of the Treasury held a critical mineral summit in Washington. That's never happened. I've never heard of that in my lifetime. A critical mineral summit being held by the U.S. Treasury. And now the U.S. is going to be stockpiling metals. Okay, so there's going to be a silver stockpile, a copper stockpile, a nickel stockpile, maybe even lithium and rare earths. Regardless of what they say about rare earths, yes, they are abundant in the Earth's crust in raw form. But the raw form of rare earths is worth zero until you process it and do a lot of chemical treatment to it to get it to an extremely high purity form, like 99999 purity, right? And same for copper. I mean, you get chalcopyrite, it looks pretty, it's cool to look at raw chalcopyrite, but it's 33% copper and it needs to be smelted. It needs to be processed to a 5/9 pure copper cathode, right? And so that requires smelting normally. And then just the US government is taking actions that we've never seen before in history. So not even in my lifetime, but never in history has the US government invested in public junior mining companies. So this is Trilogy. It's not a producer. They still have to build the mine, right? And there was a big blockage of this project that's in Alaska that has copper, silver, lead, zinc, gold. There was a blockage due to the fact they have to build a very long road in the wilderness. So, well, that blockage is now removed. And you see what Trilogy did after this news release. Perpetua got a $2 billion debt financing. Basically, this is the federal government, okay? This bank is an extension of the federal government. And then they got an equity investment, not only from the number 2 gold producer in the world, but from JP Morgan Chase. Never seen JP Morgan Chase take equity stakes in junior mining companies. And then this hit the headlines last week. Amazon is doing an offtake agreement for copper, again, high purity copper cathode, from a mine called the Johnson Camp mine in southern Arizona. And this is relevant because on my panel is Gunnison Copper, which actually runs and operates the Johnson Camp mine and the Gunnison Copper project more broadly there in Cochise County, Arizona. But the thing is, yeah, this was a nice story and it's great for Rio Tinto and Gunnison and it feels good. It's made in America copper, but they're only going to get 14,000 metric tons over the next few years, 4 years from this agreement. And to build one new hyperscale AI focused data center, they need about 3 times that amount of copper, right? So it's a drop in the ocean, what they just signed with Rio Tinto. And yeah, this got a lot of headlines, but they need a lot more. And so the whole AI data center thing is new. It's really new in the past couple of years. It wasn't well understood until now. And these campuses, it's not just one building. It's a campus. It's multiple buildings, very copper intensive, extremely copper intensive. And they're building 20 of these things right now globally. And they plan to build many hundreds more over the next 10 to 15 years. Okay, that's the plan. And so just for the data centers, the demand for copper will jump from 1.1 million tons last year to 2.5 million tons by 2040, right? And so to do that, just to bridge that 1.4 million ton annual gap, we will need 5 very large new copper mines just for the data center consumption. And to be realistic about it, does anybody know when the last time Canada permitted a large new copper mine, not an extension to an existing operation, a new one? Probably not. Well, it was Red Chris in 2012. So 14 years ago was the last time one of the biggest copper countries in terms of most copper in the earth, Canada, permitted a large new copper mine. When was the last time the US permitted a large new copper mine? Well, actually last year. It's called Copper World, also in Arizona. But this mine will produce less than 100,000 tons per year. So not even the 300,000 tons that we think of when we think of a really big porphyry copper deposit. And before Copper World in 2025, the last large new copper mine permitted was 25 years ago. It was basically the late 1990s when there was a wave of permitting in the southwest of the US for new copper mines. And so the supply, the global supply of copper doesn't really rise that much year after year. If it goes up 500,000 tons, that's a big deal, okay? Meanwhile, the demand is set to soar. It's really set to kick in this year and really in 2027 is the projection for copper moving into a much larger deficit. And so just putting into perspective, right now, copper demand is 28 million tons per year globally. By 2040, it's projected to grow to 42 million tons. So you do the math. A really big porphyry copper deposit is about 300,000 tons per year. We have to produce 14 million more tons by 2040. So how many new mines do we need, right? It's daunting. And even if we find these deposits and we permit them and the financing is available, we don't have the skilled labor. We don't have the people to operate these mines because, again, North America, US and Canada has hollowed out its resource industry. Definitely more in America, like more so in America than Canada, but still Canada is a much smaller population. So they need more skilled labor. And maybe automation, robotics, AI will help with this, bridge this gap, but still you need humans. This also bodes well for copper consumption. Run it hot. The U.S. economy is actually looking pretty good. Okay, it's picking up. The trend is up. And so we've seen M&A, right? Teck and Anglo, Rio Tinto now going for Glencore. And there's only so many big copper companies. There's literally like a handful of them, 5 or 6 of them in the world. And they've already tried to do M&A, or they've done some M&A already. And so they're going to have to look further down the food chain next. There's only so much available. There's only so many copper miners in the world. There's only so many copper mining operations in this world. And so my idea, which is definitely not a secret, and the market has caught on a long time ago, Hudbay Minerals. And I just think that even though Hudbay has had a tremendous run, it's already up a lot, it is still likely to be acquired at some point in the next couple of years, just because this M&A cycle has to happen, right? And they have Copper World that will go into production in 2029 in Arizona. They also have some investments, some stakes in some other copper juniors in Arizona, like at the Cactus Mine. And so I think that just the fact that Hudbay has a growing base of new production in the U.S. bodes well for their valuation and bodes well for their future outlook. Hercules Metals, this is in Idaho. So this is a junior. They don't even have a resource yet on their copper, but they made a porphyry copper discovery at the end of 2023. They've been drilling it out for the past couple of years. And, you could see the chart. It had a big run up on the new discovery, then it dropped back off, and it's been consolidating. It's been oscillating essentially for the last couple of years. I believe that 2026 is the year that Hercules has another breakthrough in Idaho and goes back to its 2023 highs, or maybe even makes new highs later in 2026. I believe this company will drill a hole this year that will make headlines. Gunnison Copper on my panel today. When I had them in September, we joked about how Gunnison was a haunted house. You can see that sell off in 21, 22. It was nasty, down 90%. And it was a haunted house. But this management team has taken the bull by the horns, used this more favorable market environment since the beginning of 2025, and they've gotten aggressive, right? They're thinking outside the box, got a lot of good news flow. They really know how to tell the story and do marketing. And there will be an impactful catalyst coming in February with an updated PEA for their big open pit there at Gunnison. And I bet those numbers will impress in a rising copper environment. So even though it has had a really nice run off that capitulation bottom at the end of 2024, I could still see more upside ahead in this one. And then, silver is the second most overbought in history right now. But you have to ask yourself, could silver be regaining its role as a monetary metal? And I think the answer is yes. Certainly the market is telling us that the answer is yes, right? And so, 1980, silver did not regain its role as a monetary metal. It was like a short squeeze. Some guys, the Hunt brothers, tried to corner the market. They failed, and it crashed, right? So that was kind of a frothy, unsustainable bull market there in January 1980. Dare I say this one is more sustainable because its underpinnings are not with some couple of brothers just trying to corner the market. This is global competition among sovereigns and a reshaping of the monetary order. This came out from Bank of America. Are gold and silver, in a bubble? Maybe. They're certainly extended. They're very overbought near term, duh. But look at this chart. Look at silver was supposedly in bubble territory in summer 2024. Then it was in bubble territory again in 2024. Gold was in bubble territory summer 2025. Well, the prices just kept going up, right? Yeah, whenever these markets have gotten really extended, they've had some pullback, they've had consolidation. Gold had that great consolidation throughout the summer of 2025. It was a 4-month sideways reset where price accepted the $3,400 level, and then it charted its course above 4,000 starting at the end of August, right? So I'm not moved by this Bank of America note that gold and silver are in a bubble. Bank of America says gold is on the most crowded trade. Great. That's actually really bullish. Look at what the Mag 7 was for 2 years. The most crowded trade for 2 years solid, right? And what did it, Nvidia do during this time? It did a 10x. It added 4 trillion in market cap while it was part of the Mag 7, the most crowded trade in the world. So actually crowded trade means that you're in a bull market and you're making higher highs. Capital is flowing into you. So long gold, most crowded trade. Great. And why is it the most crowded trade? Well, because central banks have been buying gold for the last 4 years. It started in 2022. Actually, it started at the 2008 global financial crisis, but it really accelerated in 2022 after Russia invaded the Ukraine, right? And nobody could understand what was happening with gold in 22 and 23. Why was it holding up as the Fed was aggressively hiking interest rates? We as market participants had been trained that when the Fed is in aggressive hiking cycle, precious metals get killed. That's the way it's been since Volcker in 1979, 1980, right? He killed that gold and silver rally in 1980 by hiking rates so aggressively. Well, China was buying. And China was, publicly stating it was buying, but it was actually buying much more. There was a lot of stealth Chinese buying. And then other sovereigns got into the game. And then in 2025, finally, the public joined in, right? So the public, private investors were completely out of gold in 21, 22, 23, 24. But then it became a competition between central banks and private investors, and the rally accelerated in Q3, Q4 of 2025. And actually, central bank buying is accelerating. Look at the dollar amounts, right? You have to adjust for the dollar amounts. Almost 100 billion of total central bank gold buying in 2025. That's by far the greatest in history. And there you can see that rally really accelerating. I mean, obviously, there was a breakout above 2100 in Q1 2024. That was the signal that we are now in a running bull market, but it actually accelerated at the end of 2025, and it's accelerating here in January 2026. And there's that gold ETF flows flipped from being negative in 2021, 2022, and 2023, basically flat in 2024, to hugely positive record inflows, $23 billion US in 2025. So that's, you have 100 billion of central bank buying, 23 billion in just one gold ETF, big money coming into gold in 2025. That's a bull market phenomenon, obviously. And this chart speaks to the declining trust globally. US dollar role in global reserves is on the decline. The dollar is still the reserve currency. It's still the number one. It's still got the title among fiat, but gold has taken the crown among all asset classes. So now gold is the reserve asset of choice because it is neutral. It does not have a flag. It does not have an opinion. And when you have the physical, you don't have counterparty risk. So this is the end of the US dollar reserve system and a new multipolar world order taking shape. And my father was the original gold bug. He taught me about gold in the early 90s. He was buying gold at $300 an ounce, and he told me this day would come. He told me that one day the U.S. would no longer be able to run huge deficits and run up massive national debts, and the dollar would lose its role as the reserve currency once it went to such an excessive level. And I guess we finally reached that point of excess 33 years later after he first told me that. So God bless him, rest in peace. The yuan is bullish for gold because now the Chinese currency is taking a greater share of global trade settlements, and a lot of that trade settlements in the Chinese currency is being diversified or being diversified into gold. So rising role of the Chinese yuan is bullish for gold. This is well known today, but it's a trend that is very strong and could still have a lot further to go, because you can see that it's still only about 8% of global trade finance. I mean, this could easily double or triple from here. So gold is a structural beneficiary of de-dollarization. So de-dollarization. So it's from unipolar to multipolar reserves. And central banks are not so price sensitive. So, this is what traders and private investors didn't really get back in like 23, 24, when gold was going to 2,200, 2,300, 2,400. The central bank bid was relentless. And that's kind of how silver feels right now. Like, it's this, relentless bid. Like, who was buying silver futures at $103 an ounce on Friday afternoon, right? That feels like a sovereign bid, right? Because I don't know traders that would necessarily be making that trade heading into a weekend when God knows what could happen in the Middle East. And so, the switch flipped at some point in 2025 when gold reserves at market price overtook foreign official holdings of U.S. Treasuries. That's a big signpost. Now, that being said, look, we're up near 5,000. It would be reasonable for gold to go sideways for a bit, to consolidate like it did in summer of 2025, or it did in Q4 2024. It's overdue, actually, for a longer sideways consolidation. March is historically the worst month of the year for gold. So maybe after the Chinese New Year in February, we will actually see gold cool off a bit. That's not a prediction, but that's just something to contemplate. A lot of people asking me, Robert, wow, the miners are up so much, the juniors are up so much, silver's up so much. I'm worried that this is a bubble, this is a top. Well, commodity cycles tend to go for at least 10 years. And so we look back to history over 100 years. It states that, it would indicate that this has further to go. The current commodity bull market started in 2020. So here we are 5-6 years later. If the track record of the last 115 years holds true, we've probably got at least another 5 years left to go. And this is a very inspiring chart. So this is the TSX-Venture composite, not a perfect proxy for the junior mining sector, but it's good enough. And certainly the junior miners are taking a larger percentage constitution of the TSX-Venture here in January 2026. So the chart is very bullish. So forget about all the macro fundamentals I just went through. Just look at the chart. Let's be guided by the chart. The true strength index making higher highs, breaking out. Yes, RSI is above 80. That's a bull market characteristic, as we know very well. And the monthly chart going back 20 years shows a completed head and shoulders bottom, and the TSX Venture has broken the neckline and heading towards 16 to 1700. That's the measured move here. Of course, you could go a lot higher, but 50% more upside is good enough for me. And then the seismic shifts, the major trend changes in the world today are expressing themselves in the ratio chart of the gold bugs index to the S&P 500 large cap index. So large caps crushed gold miners from 2012 to, all the way to 2024. Look at this. This was a failed breakdown in Q1 2024. And only just in the last 2 years have gold miners begun to outperform U.S. large and mega caps, right? And now this is this chart pattern bottom is poised to complete here in Q1 2026. And if it does, well, it indicates a lot more upside and outperformance ahead for the gold mining sector over the next 2 to 3 years. And the indicators here are beautiful. I love when the TSI is just moving above the median line. And I love when the RSI is between 60 and 70 during a breakout, because that means, we could go to 80 or 85. So we could get a lot more overbought. That means a lot more upside for price. And so this next phase of the gold mining bull market, producer PNAVs above 1.0 typically result in increased M&A activity. But when it really kicks off is when producer PNAVs move above 1.50. And that's literally what we've just seen happen in the last month with, Agnico Eagle now at 1.6 price to NAV. Barrick has finally moved above 1. Kinross is above 1.5. Newmont's at 1.4 or 1.5. So now these valuations of the senior producers are high enough that their stock, their currency, is now an attractive vehicle for them to make, more accretive acquisitions of mid-tiers and maybe even some of the bigger juniors. Probably the seniors will not venture too much under the $1 billion mark, but I would not be surprised if, companies like Probe Gold, this was October 2025, this is about an $800 million deal in Canadian dollars. Northern Superior was about a $350 million deal in Canadian dollars. And IM Gold locked up the Chibougamau Gold Camp in Quebec. And actually, Northern Superior was on my panel at MIF in May in Vancouver. And that was quite an auspicious occasion looking back at May 2025. Northern Superior was 55 cents a share that day in Vancouver. And you can see once the deal closed, the final trade, $2.59. So that was a 5x in 6 months for Northern Superior shareholders. Absolutely fantastic opportunity that was served up there. And I pounded the table on that stock many times on my Substack, and you can see interviews with Simon Marcotti, the CEO, on Goldfinger Capital Substack. So what's next, right? That's hindsight. What's next? Well, consolidation of gold camps is what's next. So you got to think of geography and synergies, because in mining, the only real synergies are in location, right? So you want the gold, the silver, the copper in the ground in relatively close proximity to one another to build a mining camp that feeds into a single processing, a mill, smelter, et cetera, et cetera. So Finland is at the top of my list because you have AEM up 550%, Kinross up 300%. Meanwhile, the juniors, which are Rupert and Orion, are up like 100 to 150% in the past couple of years. So it makes sense for somebody to lock this up. Is it Agnico? Will it be Kinross? Will there be a third party that we don't know come and surprise everybody? But it just makes sense for there to be consolidation here at the Central Lapland Greenstone belt. And so, price to NAVs above 1.5 really indicates to me that we're going to see an acceleration of the M&A cycle here in 2026. And also, historically, looking back at let's say 2006, 2007, 2012, PNAVs got above 2 before the sector topped. And in some cases, they even reached as high as 3. Now, I don't know if we can get above 3 PNAV, but this is a crazy world, and this is a market like nobody has ever seen. Even the real gray beards. I mean, I have gray in my beard, but I'm only 46. The 70 and 80-year-olds have never seen a market like this. This is once in a century type of stuff. Now, I want to leave you, just in case we get a correction here soon, which is quite possible. Again, I said March is the worst month for gold historically. Maybe this time is different. Maybe this secular trend makes seasonality irrelevant. But just in case it doesn't, in case we get a violent shakeout here in the next couple of months, I'm going to give you a trade setup that has worked well for me many times in the past. It's the bull market correction knife catch long trade. It's a setup that's kind of long-winded to say all that, but just call it the knife catch long trade. And so the key characteristics of it are the criteria. The stock has to have been in an uptrend, a strong uptrend for several months or more. And this is the first correction. It's the first real pullback, more than 5% in more than 2 months. Okay. The simple moving averages are sloping higher, confirming the uptrend. So the 40 or 50-day up and away, 100-day, 200-day, it's a confirmed uptrend on multiple time frames. It's not just a little blip. It's a very powerful uptrend. The more powerful the uptrend, the more violent the corrections are. That's a rule in markets. So just looking at how strong the gold mining sector, the precious metals have been here in January 2026, when the correction comes, expect it to be violent. It might only last for 3 days. It might last for 3 weeks. We don't know. But here's the criteria for the setup. So the daily relative strength index 14 period falls below 50, but not below 40. And the true strength index falls to near the zero line. It doesn't have to hit the zero line, but it could hit it, or it could even go slightly negative. But we want it to come down under 10. And the price, the share price, declines to the 40-day moving average or a little bit below it, right? But you need to wait for all three of these things to line up, right? You cannot take the trade when it's just 2 out of the 3. You need to have all 3 line up and coincide. Then once you take the entry, you buy, the stop loss is 2 times the daily average true range 14 period on an hourly closing basis. So that means you don't stop out if it moves under that level for a minute or 2 minutes. You need to see an hourly close. That means you're taking some risk. It's going to be a higher volatility environment. That means you need to size your position appropriately to the risk you're taking. That's a whole nother topic. That's a topic for another video, but you can send me questions if you want more details on that. And then once you're in the trade, and hopefully it starts to work in your favor, you turn green on it, there's no set target. This is a stylistic preference that's up to each trader how they want to trade it. And I'm going to give you some examples. Finally, remember that when it's the time to buy, you won't want to. So during these violent bull market corrections, when it's actually the time to buy, it'll feel like you're catching a falling knife. The market has topped. So here's a couple of recent examples. Newmont, October 2025. Look at that uptrend. Obviously, this is a classic kind of uptrend that we want to be following and trading, and it's great for the criteria of this trade setup. Here's the correction. It comes at the end of October, down 20% in 8 trading sessions, drops just under the 40-day moving average. You can see the RSI down here drops to 41. The TSI is down to 3. So it's met the criteria. We take the trade on the close. So we buy at the close on the day that the criteria is met. All of the criteria is met. And then this is what happens. Look at that. Very impressive. And again, sometimes it's very hard to hold on to these things for a couple of months, but if you buy it at 77 and it goes to 85, you take half of your position off, then it goes above 90, maybe you take profits on the rest. If you like Newmont long term, if you want to have it as a core holding, then you just keep holding it, right? You just stick in the entry and ride the trend. Kinross was another great example of this. The stronger the uptrend, the more violent the correction. This is a very strong uptrend. This was 4 days. So it dropped more than 20% from high to low in 4 days. The criteria was met on day 4, although maybe the TSI didn't get quite low enough. So we wait for confirmation, wait for the TSI to drop a little more, and here's a double bottom. We could call this a double bottom, a retest of the $22 support level. And now the criteria really is fully met. So we take the long here on the close of October 28th, and look at what happens. All right, so I'm just going to go through that again. This was a very nice example of this trade setup. The criteria is almost met here. You could take it if you really want to, but the TSI not quite there, so we could wait for technical confirmation that support at 22 really works. There it is on October 28th. We take the long, plus 50% in 2 months. Andina Copper, so this is a junior. You can see very strong uptrend, 24 cents to 58 cents. Then it comes off. Some paper starts to hit the market from their merger with Rugby Resources. And here on November 20th, it drops under the 40-day. So there we go. We got the criteria. The TSI is under 10 and RSI is under 50. So boom, the criteria is met. The criteria is met over here. Take the trade. And here we're above 80 cents in January 2026, right? So you got more than a double in 2 months off of Andina Copper. They don't always work this well, especially with juniors. And you definitely want to adjust for the volatility of the security that you're trading. Juniors definitely more volatile. If you can't take a 20% move, you shouldn't be trading a junior mining stock, right? You should just stick to the large caps. And so I conclude with my top stock ideas. This is not comprehensive, but it's good enough. We talked about Hudbay, we talked about Gunnison, we talked about Hercules, Kingfisher. This is one that presented on my panel at MIF. Dustin Perry is the CEO. Watch his presentation. Check out the two recent, the new interviews that he did in the last week. A lot to dig into with Kingfisher, but this is definitely one of my top picks for 2026. So with Hercules and Kingfisher, Porphyry Explorers, fantastic. You could put Andina as well in that list. And then gold miners, Sitka Gold, Talisker Resources, and Endurance Gold. We talked about Orion, and then Aztec down in southern Arizona. And then from energy, Chevron, so really boring, mega cap, but I love the chart. I love the fundamentals. I think this will trade above $200 in the next year. And then for those who want to take a little more risk, Sprott Physical, Uranium Trust, and Standard Uranium, a junior explorer in the Athabasca Basin. Thank you so much for your time and for being a subscriber and viewer of Goldfinger Capital. Enjoy a peaceful weekend.